Okay, so you want to buy a bank in Switzerland. The whole fantasy. A discreet townhouse on a quiet street in Geneva, a brass plaque with a name and a founding date, a private vault under the Alps, and clients who arrive by appointment and speak in whispers. You already picture yourself as the man who keeps the world's secrets. Here is the problem. The single most famous asset in Swiss banking, the secrecy, has been dead for a decade, and the second most famous name in Swiss banking, Credit Suisse, went to zero on a Sunday afternoon in March 2023 and got handed to a competitor for 3 billion francs, which was less than its office real estate was worth. So before you buy the townhouse, understand what you are actually buying. It is not a vault. It is a very expensive, very heavily policed machine for storing other people's money, and it makes almost all its profit from a fee most owners can barely explain out loud. Let's go shopping anyway. At the entry end of the catalog is the thing most people don't realize is the cheap tier, because it isn't a bank at all. It's a Swiss asset manager or portfolio manager license. Minimum capital, 100,000 francs. You manage rich people's money, you take a fee, and you never touch a deposit. One rung up is the fintech, or deposit, license. Minimum capital, 300,000 francs, which lets you hold up to 100 million francs of public deposits as long as you don't lend them out or invest them. This is the tier every neobank founder thinks they want. Then there is the securities firm at 1.5 million. And only at the very top of the ladder do you reach the actual object of your desire, the full banking license. Here is where the sticker shock starts. The statutory minimum capital for a Swiss bank is 10 million francs, fully paid in. That is the number on the government website, and it is a trap because no serious application has ever succeeded on it. The regulator, FINMA, expects at least another 10 million on top. And Swiss licensing lawyers will tell you plainly that a real niche bank starts at around 20 million francs, and most start with far more. And that is before Basel III capital rules, which scale your required capital to the size and risk of your balance sheet. The 10 million francs isn't the price of the bank. It's the deposit you leave at the door to prove you're serious. And above all of this, the shelf you can look at, but not casually buy, sit the real Swiss names, the ones you actually pictured when you started daydreaming. Pictet in Geneva, founded 1805, looking after roughly 724 billion francs. Julius Baer in Zurich, founded 1890, around 497 billion. Lombard Odier, Vontobel, Union Bancaire Privée, J. Safra Sarasin, the group the industry calls the Big Eight, each managing well over 100 billion francs of the world's wealth. These are not for sale for a license fee, and often not for sale at all, because several of them are private partnerships whose owners have no interest in your money. The catalog top is a museum. You can visit, you cannot check out, which is worth sitting with for a second, because it tells you what kind of shop this really is. There are only somewhere around 80 dedicated private banks left in the whole country, down from over 100 a decade ago, and the number is still falling every year through mergers and quiet closures. The biggest deal in the sector in the last 10 years, Safra Sarasin buying Saxo Bank, was two survivors combining, not a newcomer arriving. This is not a growing market you are joining. It is a shrinking club you are trying to buy your way into, and the members are actively eating each other. So where do you buy one? The Build It New route is the honest one, and also the one that will age you. A full Swiss banking license is not a form. It is a prudential file that has to be built, and FINMA will not authorize you until the humans are already on the payroll. Compliance officers, risk managers, IT staff, front office, all hired, all sitting in chairs, all being paid before you are allowed to earn a single franc. You are running the full cost base of a bank for months, sometimes years, purely to earn the right to open. But you're impatient and rich, so you look at buying an existing Swiss bank off the shelf. Now you're paying for the thing that actually has value, which is not the vault and not the brass plaque. It's the book, the assets under management, and the client relationships attached to them. A Swiss private bank is priced as a percentage of the money it looks after, typically somewhere between 1 and 3% of assets under management. So a bank with 10 billion francs of client money might change hands for somewhere in the low hundreds of millions, depending on how profitable and how sticky those assets really are. And that money is loyal to one person, and that person is not you, which sets up the trap in the bargain, and it's the oldest trap in this industry. The clients belong to the relationship managers, and the relationship managers can leave. When Credit Suisse fell apart, rivals went on a record hiring spree, poached the client advisors by the hundred, and the money walked out the door behind them. EFG alone hired so aggressively in the aftermath that its net new money blew past its own targets, and almost none of that was new wealth appearing from nowhere. It was somebody else's book, arriving with the banker who used to run it. You can buy the bank. You cannot buy the loyalty. It resigns, and it takes the assets with it. And then there is the distressed aisle, which in Swiss banking is less an aisle and more a mass grave. Yes, you can buy a struggling Swiss bank cheap, sometimes very cheap. And the reason it is cheap is always the same. Either the assets are leaving, or the compliance file is a landmine, or there is a foreign regulator somewhere holding a grudge and a subpoena. In 2024, a FINMA-licensed institution called MBR Merchant Bank was put into liquidation despite holding a full banking license, which is the cleanest possible proof that the license is not a life jacket. A cheap Swiss bank is cheap because somebody who understands Swiss banking looked at it very carefully and decided not to buy it. You are not finding a bargain nobody noticed. You are finding a problem everybody already priced. First, though, your first bill, and this is where the fantasy quietly dies. Day one, before a single client, you are paying for the most expensive workforce in world banking. In 2024, Swiss private banks reported personnel costs of about 10.6 billion francs across the sector, which is roughly two-thirds of all their operating expenses. People are the machine, and Swiss private banking people cost more than almost any other kind. On top of the salaries sits the compliance apparatus, which in Switzerland is not a department, it's the whole building wearing a department's clothes. Every non-resident client you take on needs enhanced due diligence, source of wealth documentation, cross-border screening, and permanent transaction monitoring, and that cost lands whether the client has 10,000 francs with you or 10 million, which gives us the number that governs your entire existence, the cost-income ratio. In 2024, the average Swiss private bank spent about 75.5 centimes to earn 1 franc of income. Read that slowly. 3/4 of the revenue is eaten before profit begins, and the KPMG and University of St. Gallen study found that only 31% of Swiss private banks actually earned back their cost of equity that year, which is rule number 1 of Swiss banking. Everyone assumes the hard part is getting the money in, but the hard part is being allowed to keep any of it. So how does the machine actually make money? And here is the reveal that reframes the whole business. It is not the vault. It is not interest, because with Swiss reference rates back at zero, the interest tailwind that flattered everyone's profits has quietly vanished. It's the fee. You charge a client roughly 1% of their assets every year for looking after them. That's it. That's the engine. 1% forever on a pile of money that ideally just sits there and grows on its own. Think of the whole operation as a car park for wealth. You are not driving the cars. You are not fixing the cars. You charge rent on the space every single year, and the beautiful part is the cars mostly appreciate while parked, so next year's rent is higher than this year's for doing exactly nothing. Which is why there is a hard floor under who you're even allowed to serve, and the floor is pure arithmetic, not snobbery. A single relationship manager in Geneva costs the bank 200,000 to 400,000 francs a year, all in, and handles maybe 30 to 60 clients. At a 1% fee, a client needs to be holding somewhere around 1.5 to 2 million francs before that relationship even breaks even. Below that, the bank is paying to look after you. That's the whole reason the minimums exist. When you hear a Swiss private bank has a 2 million franc minimum, you're not hearing exclusivity. You're hearing a parking space that costs more to clean than the car pays in rent. Now, the graveyard. And Swiss banking has the most instructive graveyard in finance. Start with the ghost that built the whole industry, secrecy itself. In 1934, the Federal Banking Act made it a criminal offense, punishable with prison, for a banker to disclose a client's identity. For 75 years, that single sentence was the product. Then, starting in 2008, the United States Department of Justice took it apart. UBS settled in 2009, paid $780 million, and handed over the names of thousands of American account holders, which under the 1934 law was supposed to be unthinkable. Switzerland then signed on to the automatic exchange of information with more than 90 countries, and the secret, the entire original product, was simply switched off. The lesson: the thing that makes your business special is usually the thing a bigger government will eventually decide it doesn't like. Second grave, and it is a real headstone. Wegelin and Company. Founded in 1741 in St. Gallen, older than the Swiss Confederation, the oldest bank in the country. In 2012, it was indicted in the United States for helping Americans hide money, pleaded out, paid its penalties, and then did the only thing a 270-year-old bank can do when the game changes underneath it. It closed, forever. 2.5 centuries of history, ended by a single foreign prosecutor. The lesson: in this business, age is not a moat. It's just a longer distance to fall. Third grave, the fresh one, and the one you cannot look away from. Credit Suisse. Founded 1856, a globally systemic bank, one of 30 on the planet that regulators consider too big to fail. In March 2023, after years of scandals and losses and one very bad week, its clients pulled their money faster than it could hold on to it. On the 19th of March, Swiss authorities forced a rescue. UBS bought the entire bank for 3 billion francs in shares. And here is the part that should make every prospective bank owner sit very still. FINMA ordered roughly 16 billion francs of Credit Suisse's additional Tier 1 bonds, about $17 billion, written down to zero, while shareholders still walked away with 3 billion. The people who thought they ranked ahead of the equity got nothing. The equity got something. In banking, the hierarchy of who loses money is not a law of nature. It's a decision, and it gets made in a weekend in a room you are not in. In late 2025, a Swiss court actually ruled that write-off unlawful years too late for anyone who was wiped out. The lesson, and it's the whole video in one line. A Swiss bank can be 167 years old, systemically important, and worth nothing by Monday. So let's calculate how much you'll actually earn. You've bought a small Swiss private bank with 10 billion francs of client assets, which sounds enormous and is genuinely mid-sized here. In the optimistic scenario, markets are kind, your relationship managers stay, and you run at the sector's better end. 10 billion francs of assets at a 1% all-in margin gives you 100 million francs of income. You run a disciplined cost-income ratio of 70%, so 70 million francs of costs, and 30 million francs of pre-tax profit. On top, net new money flows in, say 5%, because a rival collapsed and their clients needed a new home, and your asset base grows to 10.5 billion for next year, so next year's rent is already higher. Not bad. In this scenario, you look like a genius. Now, the realistic one, which is just the same bank in a normal year. Interest income has gone to nothing because rates are at zero. Your cost-income ratio drifts to the sector average of 75.5%, because compliance costs only ever go up, and your best relationship manager just left for Julius Baer and took 400 million francs of assets with her. Income drops to 92 million, costs hold stubbornly at 70 million, and your pre-tax profit is closer to 22 million, before Swiss taxes, before the one-off legal bill from a client dispute, before the regulator asks you to hold more capital just as your profit falls. You are still profitable. You are just working inside a machine where 3/4 of every franc is spoken for before you see it. Your single biggest asset can quit, and your entire client base can be repriced to zero by an emergency ordinance you didn't get to read. Payback on the purchase price, in that scenario, stretches out over many, many years, and every one of them depends on markets you don't control and managers who can walk. This is education, not financial advice, and past performance in Swiss banking very obviously does not guarantee future results. Ask a Credit Suisse bondholder. If this was useful, subscribe, and drop a comment. Would you rather own the little Geneva private bank with the loyal clients or the giant global one that's too big to fail? Right up until the weekend, it isn't. Because here is what you actually bought. Not a vault, not a secret, not a moat made of history. You bought a car park for other people's money, where the government took your 10 million francs to let you in. The compliance department eats 3/4 of the rent. The cars can drive themselves out whenever they like. And the whole lot can be condemned in a single weekend by people who will never tell you why. The Swiss didn't get rich keeping secrets. They got rich charging 1% a year to hold the door. And they only figured out the second part after the world took the first part away.